Good morning, everybody. It's Monday, August 5th, 5:25 a.m. Central Time. Grain markets are a little bit lower this morning, fairly quiet trade. The action is in the outside markets. We've got I guess I'll call it a collapse in the stock market. The Dow Jones down about 750 points in the futures markets. S&P's down 155. Let's start off with Friday's jobs report.
So, U.S. recession fears have sent global equity markets sharply lower. The U.S. unemployment rate reported Friday hit 4.3% in July, up from 4.1% in June, and the fourth consecutive monthly increase. Nonfarm payrolls in July increased by 114,000, well below the Dow Jones estimate of 185,000. The stock market plunged following the release of the data. The Dow Jones lost 1.5%, the S&P 500 fell 1.8%, and the Nasdaq declined by 2.4%. Equity futures traded sharply lower on Monday morning. Japan's benchmark Nikkei index lost 12.4% on Monday, its largest one-day decline since Black Monday back in 1987. The VIX, Wall Street's fear index, rose to its highest level since June 2020 early this morning. Analysts at Goldman Sachs now believe there is a 25% chance of a U.S. recession during the next 12 months.
This appears to be the jobs report that changed a lot of things. And for the moment, yeah, recession fears increased certainly. This is just, we had some frothy markets in stocks and some other things, and you're seeing some mean reversion here. It's kind of a sell now, ask questions later type deal. Looking at the non-farm payrolls, 114,000 was a big miss. Looking at unemployment, 4.3% is the highest since 2021. And this is the level, I suppose, that triggers recession fears. It has increased a little bit. When you look at the S&P 500, this is the most important stock market index on the planet. We've seen a 3-day loss of almost 6.5% from the close Wednesday last week to the overnight low in the futures markets. The cash markets aren't open yet this morning, but that's a 6.4% loss in the span of really like 2.5 trading days, which is really, really severe. You've got a market here in U.S. equities that have seen very, very little volatility so far this calendar year. So part of this is because there's recession fears, and part of it, in my opinion, at least, is just mean reversion. We went so long without any sort of volatility, and it's all kind of coming at us at one time. Japan, I'm not overly concerned about what's going on in Japan. That's a different world. This is not the index we should care about, but 12.4% loss in one day is not good. That's a nasty, nasty bar on the Nikkei and the ugliest since 1987. Looking at the VIX, which is your volatility index, they call it the fear index on Wall Street, spiked to just over 40 overnight, which is the highest since June 2020. And in June 2020, we were still coming out of COVID. We were very much in the midst of COVID still, I guess. So it's ugly stuff. There now, this is the CME Fed tool this morning, and I don't know how real this is. It says there's a 96% chance of a half-point rate cut in September. And this is, I believe, like auto-generated based on what's going on in the interest rate markets. So there's a lot of fear here early this morning, a lot of fear and a lot of selling.
Hedge funds have become pessimistic about commodities due to economic concerns. For the first time since 2016, investors have largely pivoted to a bearish position on commodity futures. Even through the pandemic, investors held a net bullish stance on commodities. The shift is partly due to concerns over the economic slowdown in China. Additionally, abundant supplies of commodities such as corn and nickel have also caused investors to shy away. As of last Tuesday, money managers held a net short position of 58,600 contracts on a basket of 20 raw materials.
Recessions are not good for commodities because you see reduced demand, essentially. If the economic slowdown is real, you see reduced demand. And that's what we're seeing here across this basket of commodities that Bloomberg tracks. I've got my Bloomberg Commodity Index chart here, and we are actually trading this morning below this support line that I've got drawn here. We've got a lot of pressure in a lot of things. Energies in particular are sharply lower this morning. Crude's down like $1.50. Natural gas has been sharply lower for a few consecutive days. The grain markets, of course, not acting well. Where is your risk in commodities right now? Your risk, in my opinion, would be in the commodities that were priced higher. Your grain markets have already gotten hammered, right? Where's the risk? You see what cattle did on Thursday and Friday last week?
Yeah.
Those are markets that are commodity markets where, the funds are still long and now they want out. So again, it's a sell now, ask questions later type deal. They just large money managers in this sort of situation, if you've got a pending recession, which is a big if. Goldman says 25% chance. Okay, fine. But if you're long something that has substantial downside risk, like maybe cattle or feeder cattle, those are the markets to be concerned about. You look at the grains this morning, corn's down 2 cents, beans are basically flat, wheat's down just 5 or 6. They're not doing much because they've already gotten beat up. The funds are already short. We already know that demand sucks. So some of the commodity markets rather that are priced higher, that have acted better, those are the ones that are probably at risk.
So if you guys have not already checked out our premium content, you sure need to do so. Joe, can you tell me about some of last week's premium videos?
Some good stuff late last week. I did a chart view, Brazil versus U.S. soybeans on Thursday. I talked about Brazil acreage expansion and kind of compared, like, Brazilian soybean acreage versus U.S. soybean acreage, Brazil production versus U.S. production, exports being compared. We compared Brazilian soybean exports with Chinese imports, which is a super interesting comparison. I had a PDF download with a bunch of cool charts. And Friday, Jim was on. We talked about Social Security, among other things. Is it really a scam? I think this one was like a half an hour long. We talked about Social Security. We talked about some political stuff as it relates to commodities, grain markets, that sort of thing. If you guys want to see the premium stuff, go to standardgrain.com. You can sign up this morning. This is a $50 per month subscription. You can cancel at any time. No other fee, no other obligation. Nobody tried to sell you anything else. Sign up today. I'll forward you a copy of this morning's email, which includes the 6 most recent premium videos, all of my cash grain marketing recommendations. Give that deal a shot this morning.
Fund traders continue to hold a massive net short position in the corn market. CFTC released weekly commitment of traders data on Friday. During the week ending July 30th, the funds were net buyers of 34,000 contracts of corn. The net short of 300,000 contracts of corn is the 4th largest on record. Funds were net buyers of 3,000 contracts of soybeans. The net short of 170,000 contracts of soybeans is the 3rd largest on record, and funds were net sellers of 3,000 contracts of SRW wheat on the week.
For all intents and purposes, I mean, funds are still record short the row crop markets within a margin. So they're sitting short here. And that's why you're not seeing the volatility in the grains this morning with all this crazy stuff going on in the outside markets, is because the funds are already so large money managers, large speculators, they're already so heavily short. They probably feel pretty good about that position if we're headed toward a recession, which again is a big if. This is just, it's all happening very quickly just in the last couple of trading days. This net short across corn, soybeans, and SRW wheat, 546,000. It's not as big as it was a few weeks ago, but it's again, for all intents and purposes, a record net short across those 3 contracts.
Weekend rainfall across the U.S. Corn Belt was minimal. Eastern areas, including parts of Indiana, Kentucky, and Ohio, saw scattered rains. The vast majority of Iowa and Illinois were dry. Rainfall over the next 5 days is likely to favor parts of Minnesota, Wisconsin, and Michigan. More widespread rainfall is likely over the central and northern U.S. plains during the 5 to 10 day period. Temperatures are slated to run below normal across the region through at least the next week.
Despite a forecast that is not overly wet for the Corn Belt, most of your rain is going to be in that 5 to 10 when it gets wetter. It's going to be in the Dakotas, Nebraska, parts of eastern Kansas, but a lot of Iowa will be dry, a lot of Illinois dry, Indiana dry, Ohio dry. The market doesn't seem concerned. You've got lack of heat. It's more benign than super favorable, but the market doesn't see this as being a problem.
USDA reported a flash sale of soybeans on Friday. U.S. exporters sold 7 million bushels of soybeans to China for delivery during the next marketing year. The sale comes on the heels of Thursday's flash sale of 5 million bushels of soybeans to China.
Totally normal activity. This is what you're going to see year in and year out at the very least. At the very least, you're going to see these flash sales, 132,000, 202,000. This is routine stuff. What we need to see is 400, 500, 600,000, a million metric tons. And we haven't seen that yet. So the market doesn't really care about this. The pace of new crop soybean export sales out of the U.S. is very poor. We're just barely above where we were in 2019, which was associated with the trade war in terms of commitments. So it's still not good. And those small Chinese purchases, they don't move the needle in terms of sentiment. Tell us about the cattle market on Friday.
It was just another train wreck of a day. Feeders closed an average of $4.15 lower. Live cattle were down an average of $2.02 lower. Last week, the whole week across the board, August feeders dropped almost $10. Cash cattle trade was lower last week. In the north, cattle traded at $196, $2 lower than the prior week. In the south, cattle traded at 188, which was also $2 lower than the previous week. Box beef was mostly unchanged on Friday and on the week. Choice ended the day at 313.77. That was up 98 cents. And select ended the day at 297.17. That was down 29 cents.
Outside markets, again, very active. U.S. dollar is sharply lower. The S&P is down 157 points, which is a huge move. The Dow Jones futures down 770, closing in on 39,000. Bonds are up, which means rates are down. Crude oil is down $1.46, and the September WTI at 72.04. Crude, natural gas, the energies have gotten beat up the last couple of days. Have a great day, guys. We'll talk to you on Tuesday.